During the first week under the new president, the dollar lost about 1% of its value, weighed down by Trump's failure to implement any immediate tariff measures. During his speech at the World Economic Forum in Davos, he also called for further rate cuts. Lower interest rates in the United States mean a cheaper dollar. On the other hand, the US Fed Reserve is not inclined to dance to the president's tune. It's unlikely that Fed Chairman Jerome Powell will announce an interest rate cut on January 29th. In the meantime, let's take a look at the economic data scheduled for release on January 27th and 28th. You're watching Traders Calendar. Monday begins with the statistics from China. In anticipation of clarity regarding US trade tariffs, Beijing finds itself in a difficult position. On the one hand, it needs to save the economy, but on the other, it's unclear how to do so. The Chinese economy is sending mixed signals. For example, last month's manufacturing PMI fell short of expectations, falling from 50.3 to 50.1 points. Thus, even a modest uptick of 0.1 points could be positive, especially for oil prices. Reports from Germany are also raising concerns. Europe's largest economy is increasingly warning of a recession, which is naturally weighing on the euro. Business sentiment data is expected to remain weak. While the business climate indicator stood at 86.5 points last October, it's a forecast to drop to 84.5 points in January, putting pressure on the euro. Meanwhile, the US economy continues to provide traders with more evidence of its resilience to the Fed's high interest rates. In the housing sector, for example, the number of new single-family homes sold is expected to rise to 670,000. This number indicates a strong buyer demand, which, as we know, it's a key driver of economic growth. A strong US economy means a strong dollar. For those doubling the strength of the US economy, the dollar's Fed's Texas Manufacturing Activity Index may provide further convincing evidence. In December, the index moved out of negative territory, posting a gain of 6.1 points. A further increase to 4 points is expected for January, which would benefit the greenback against its currency counterparts. Recently, both the Australian and the New Zealand dollars have found reasons to resist the pressure from the US dollar. However, it would be overly optimistic to suggest that the Pacific currencies are offering strong resistance to the greenback. The main cause of this volatility lies in the economies of these countries. For example, Australia's business confidence index fell from 5 points in October to -3 in November, but an expected rise of 3 points in December could support anti-Biden currencies and the oil prices. Looking at the US statistics, the durable goods orders report is also worth watching. After rising 0.8%, the index fell to -1.1%, but it's expected to rebound by 0.8% in January. Given that this indicator has a lagged effect influencing future consumer demand and inflation, its impact on the dollar may be muted for now. Similarly, the US Consumer Confidence Report reflects a wide range of issues, including labor market conditions, business climate, and overall economic health. The previous December reading fell short of expectations by more than 8 points, coming in at 104.7. Expectations for January are more modest, around 106. However, even this level is likely to be seen as a positive and could push the dollar higher. Please note that the publication times are set in Moscow time, GMT+3. The next video review of a Traders Calendar will be released on Tuesday, January 28th. And how we're going to be in the short-term and financial market, we will definitely tell you in our next news releases. Subscribe to our channel and follow news with us. See you soon.